If you've been on the hunt for income lately, I bet you've noticed this new breed of options-powered funds. They're promising some absolutely massive yields. And you know, a real standout in that crowd is an ETF with the ticker QBTSTE. So let's dive into this thing and see what's really going on with this high-yield machine.
First things first, let's just get right to the number that has everyone's head spinning. We're talking a trailing distribution rate of around 38%. And get this, it's paid out weekly. That's the kind of headline figure that literally stops you in your tracks and makes you ask one really important question.
Yeah, exactly. How on earth is a yield like this even possible from something linked to the stock market? That is the central question we're going to unpack right now. And to get to the real answer, we have to look way past that headline number and get right into the mechanics of it all.
To understand the output, that giant yield, you have to understand the engine. And QDTE's engine, well, it's built around a very specific, and these days, a very popular type of financial instrument.
So, the fuel for this engine is something called 0DTE options. That stands for 0 days to expiry. Think about that. These are options that literally live and die in a single trading day. And what's wild is just how massive this market has become. This isn't some tiny niche product anymore. It's a huge shift in how the market works. All that volume and the daily volatility it creates, well, that's the raw material QDTE harvests for its income.
So how exactly do they do it? It's a daily, well, it's a rinse and repeat process, really. First, the fund gets its exposure to an innovation-focused index using what are called synthetic positions. Then, every single morning, right around the opening bell, it sells call options that are going to expire that very same afternoon. That brings in immediate cash. And because those options are sold fresh each morning, the fund is typically uncapped on any big moves that happen overnight. Then, the next day, guess what? It does it all over again.
Okay, now we get to what is probably the most important part of this whole explainer. We know where the cash comes from, selling those options, but what is that cash? From an accounting and tax perspective. This is where the story gets really, really interesting.
A really common assumption when you see a high yield is that you're getting a slice of corporate profits, kind of like a traditional dividend. But in this case, that couldn't be further from the truth. Not even close.
And here it is. This is the crucial detail. The key point is that, according to the fund's own estimates, these huge weekly payouts have recently been 100% return of capital. This changes absolutely everything about how you should think about that 38% number.
So, what is return of capital? Well, to put it simply, the fund is just handing you back a piece of your own money. It's not a profit, it's not a dividend. The main effect is that it lowers your cost basis. What that means is you get to defer paying taxes until you actually sell your shares, but, and this is a big but, at that point your capital gain is going to be larger. It's a really critical distinction to understand.
All right, so knowing this is a high-octane engine fueled by 0DTE options and is paying you out with your own capital, we have to talk about performance. Because like any specialized engine, it has specific weather conditions where it runs beautifully, and others where it can definitely sputter.
And this just lays it out perfectly. It's a tale of two markets, right? This strategy absolutely loves choppy, sideways markets, where it can just sell options and watch them expire worthless day after day, generating that consistent cash. Now, where it can get hurt is in a strong trending market. If the index just rips higher all day, your upside is capped. And here's the other thing. If volatility completely dries up, the premiums it collects, the actual fuel for the yield, well, they can shrink dramatically.
So why has this been so popular? Well, because the past year delivered a near-perfect cocktail of conditions. I mean, think about it. Not only did it produce that massive 38% distribution, but the fund's price also went up by around 20%. Getting paid a huge income while your principal also grows, I mean, come on, that's the dream scenario, and it's exactly what fueled the massive interest in this fund.
Okay, let's put all these pieces together. Time to land on a final verdict and put QDTE into context with some of its peers out there in the high-income space. So when you look at the landscape, you can really see just how unique QDTE's approach is. Meanwhile, funds like QQQI are using monthly options, and FEPI is focusing on individual stocks, QDTE and its cousin XDTE are specialists in this daily, intraday, 0DTE game. The key takeaway here is that it's targeting a very, very specific slice of income. Daily option premium on a growth-oriented index.
This right here is probably the most important takeaway from this entire analysis. That 38% number is an output. It's a result of past market conditions.
What you're actually investing in is the engine itself, that daily 0 DTE covered call strategy. And that yield, it will change as the market weather changes.
So, before you'd ever consider a fund like this, it is absolutely essential to ask yourself these 5 questions. Seriously. Do you get the mechanics? Are you really okay with the fact that the weekly payout is going to fluctuate? What's your plan for the cash it kicks off? Thinking through these questions will help you decide if the strategy truly fits your goals and, maybe more importantly, your temperament.
Ultimately, it really just comes down to this. QVTE is a powerful, very specialized tool. It's designed to do one thing: turn intraday volatility into weekly cash flow. It's not a bond, and it's not a simple dividend fund. Understanding its engine is the absolute key to knowing whether this high-octane strategy has a place in your portfolio.